Welcome to our deep dive on managing windfalls when you have a major purchase within 2 to 3 years. We will prioritize capital preservation, discuss safe havens like high-yield savings accounts, certificates of deposit, and short-term treasuries, and explain why broad equities are generally inappropriate for this timeline. We will include a step-by-step plan, diagrams, and quizzes to reinforce the concepts. Let's begin by laying out the agenda. Here is our roadmap. First, we'll cover why safety overrides growth when your goal is near-term. Next, we'll rank the safest parking spots: high-yield savings accounts, certificates of deposit, money market funds, and short-term treasury bills. After that, we'll walk through a 3-year plan including CD laddering. We'll also touch on tax efficiency and liquidity. Then, we'll explain what to avoid, especially equities. Finally, we'll test your understanding with brief quizzes and summarize the key takeaways. The central principle is simple and non-negotiable. If you will need the money within 5 years, your first goal is to preserve capital. This is because volatility can erase gains right before your purchase. Therefore, choose stability over speculation. With that core idea in mind, let's analyze why safety is paramount. The flowchart shows that if your time horizon is 5 years or less, you should prioritize capital preservation. Volatility combined with a short timeline creates sequence risk, where a market decline near your target date can cause significant damage. Liquidity is also critical so you can access funds without penalties or losses. The goal is to match your financial vehicle to your objective, near-term stability. If your horizon exceeds 5 years, then long-term investing may be appropriate, but that is not our focus today. Here are the steps. First, specify the purchase date and required amount. Then, split your windfall between an emergency buffer and the dedicated purchase fund. Next, select your primary vehicles: an HYSA for immediate liquidity, CDs for potentially higher fixed rates, and short-term treasuries or money market funds for efficiency. If you choose CDs, build a simple ladder to stagger maturities. Set recurring check-ins to roll maturing instruments and keep the plan on track. As you approach your purchase date, increase liquidity by moving funds into instantly accessible accounts. Finally, do not mix risky assets into this short-term goal. Reserve those for long-term investing. This table compares common vehicles. High-yield savings accounts offer instant liquidity and FDIC or NCUA insurance within limits. Interest is fully taxable. Certificates of deposit usually require holding to maturity for best results, with FDIC or NCUA coverage up to limits. They may offer higher fixed rates but restrict liquidity, which is why laddering helps. Treasury bills are backed by the U.S. government and often have interest that is exempt from state and local taxes, which can improve after-tax returns for larger sums. Money market funds typically invest in very short-term, high-quality instruments. While not FDIC-insured, government or Treasury money market funds carry low credit risk. Always verify specific terms and coverage. High-yield savings accounts are the default parking spot for near-term goals because they provide instant access and FDIC or NCUA insurance up to legal limits. Rates are variable, but the convenience and protection are compelling. They are also easy to link to your checking account and to automate transfers, making them an excellent base for both emergency funds and short-term goals, such as a down payment. A CD ladder staggers maturities, for example, 1, 2, and 3-year CDs, so that part of your cash becomes available each year. This can deliver higher average yields than keeping all funds in an HYSA while still providing periodic access. As you approach your purchase date, you can direct maturing CDs into your HYSA to maximize liquidity. Avoid early withdrawals when possible because they may incur penalties. Always match CD terms to your actual timeline so you are not forced to redeem early. Short-term treasury bills are backed by the U.S. government and typically mature within a few weeks to a year. Their interest is often exempt from state and local income taxes, making them attractive for larger sums in higher tax states. Treasury or government money market funds provide daily liquidity and invest in high-quality, short-duration instruments. Some funds focus primarily on treasuries. Review settlement times, any purchase/redemption cutoffs, and expense ratios to ensure they fit your needs. These options can complement or substitute for bank products depending on your tax situation and liquidity needs. On the left are vehicles aligned with short-term goals: HYSAs, CDs, T-bills, and money market funds. They prioritize principal protection and provide more predictable access with lower volatility.
Tax-aware choices, such as Treasuries, can improve after-tax returns. On the right are broad equities, which may be appropriate for long-term growth, but introduce timing and drawdown risks that conflict with a fixed, near-term purchase. Mixing equities into this bucket can jeopardize your outcome if markets decline at the wrong time.
Quiz time. The question asks what your top priority should be if your purchase is within 2 to 3 years. The options are maximizing stock market returns, capital preservation and liquidity, buying individual corporate bonds with long maturities, or day trading to beat inflation. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is capital preservation and liquidity. For a near-term purchase, your focus should be protecting the principal and ensuring access, and only then optimizing yield within safe, appropriate instruments. This diagram maps the decision process. You begin with a windfall and first assess the time horizon. If it is within 5 years, you prioritize capital preservation. Then you decide whether you need immediate liquidity. If so, an HYSA is appropriate. If not, consider a CD ladder. From the preservation node, you can also choose short-term treasuries or government money market funds. For horizons beyond 5 years, you would consider long-term investing strategies, which lie outside our scope. Finally, all short-term paths converge on a reminder to increase liquidity 3 to 6 months before the purchase date. This pie chart shows an illustrative allocation across an HYSA for liquidity, a CD ladder for fixed yields, and short-term treasuries, or a government money market fund for tax-aware efficiency. This is not investment advice. It is a conceptual example. The exact mix depends on your timeline, risk tolerance for this specific goal, and local tax considerations. As maturities occur and your purchase date approaches, shift progressively into higher liquidity. Our second quiz asks whether you should allocate 10 to 30% to broad equity index funds for a 2 to 3 year down payment goal. The options are: yes, a small equity slice is always prudent. No, equities add unacceptable volatility for this goal, only if interest rates are low, or only if you can time market dips. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is no. Equities introduce unacceptable volatility for a defined short-term goal such as a down payment. Short-term objectives require security and liquidity, avoid timing risk, and focus on protecting the principal. Here is a quick operational checklist. Define the exact goal and date. Set up your HYSA and necessary account links. Decide on CD ladder terms that fit your timeline. Evaluate whether to use Treasury bills or a Treasury or government money market fund. Set calendar reminders to roll maturities and reinvest as needed. Increase liquidity 3 to 6 months before the purchase. Keep equities separate from this short-term bucket. These are the key takeaways. First, money needed within 5 years should prioritize capital preservation. Second, use HYSAs for liquidity, CDs for fixed rates, and short-term treasuries or money market funds for tax efficiency. Third, ladder CDs and set check-ins to manage maturities. Fourth, increase liquidity as you approach the purchase date. Finally, avoid equities in this short-term bucket. To summarize, define your timeline and the exact cash requirement. Select safe, liquid, and tax-aware vehicles such as HYSAs, CDs, and short-term treasuries or government money market funds. Implement a CD ladder if appropriate and automate rolls. Stay disciplined and prioritize stability over speculation to protect the funds you will soon need. Please note this important disclaimer. The content you are viewing is educational and not financial, tax, or investment advice. You should consult a qualified fiduciary advisor and a tax professional for guidance tailored to your specific circumstances. Rates, terms, and regulations can change, and you should verify all details with your financial institutions. Insurance coverage such as FDIC or NCUA applies only within stated limits and ownership categories. Thank you for watching. If you found this valuable, please like the video, share it with someone who might benefit, and subscribe for more content. Let us know your 2 to 3 year plan in the comments.